You know, when you walk into a massive casino resort, everything feels just entirely engineered to manipulate your senses.
Oh, absolutely. The lack of clocks on the walls, those maze-like patterns on the carpet.
Right. And even the way the lights on the slot machines are programmed to flash at like very specific frequencies.
It's all highly calculated.
It is. You get this overwhelming feeling that the house has absolute deterministic control over every single penny in the building.
Which is funny because they really don't.
No, they don't. Because when you strip away the neon and look at the raw financial data of a global gaming empire specifically, the MGM Resorts fourth quarter and full year 2025 earnings call we are unpacking today, you realize the control is, well, it's an illusion.
A total illusion.
Yeah. They're desperately trying to surf this chaotic ocean of macroeconomic trends, international diplomacy, shifts in consumer psychology, and honestly, sheer dumb luck.
That's a great way to put it. The contrast between the physical environment of a casino and the reality of the balance sheet is striking.
Exactly. And that's why we are taking a highly data-forward approach today. We're going to strip away the dense Wall Street jargon, pull out the hard numbers from this earnings call, figure out the underlying mechanics driving those numbers, and deliver an opinionated bottom line on what this means for you as an investor.
Because an earnings call of this magnitude, it tells us an intricate story. It's about human behavior, where discretionary income is flowing, and strategic capital allocation on a multi-billion-dollar scale.
We are looking at a post-boom stabilization in Las Vegas, a massive turnaround in digital betting, and some seriously aggressive international expansion. So, okay, let's unpack this.
Let's do it. Where should we start?
Let's start right at the absolute foundation. We need to look at the overarching financial performance and what the industry is calling the Great Vegas Reset.
Right, the reset.
Because for anyone holding this stock or, just following the travel industry as a leading economic indicator, the burning question has been whether the post-pandemic travel boom has finally busted.
And the numbers give us a pretty clear answer to that.
They really do. Looking at the scorecard for the full year of 2025, MGM achieved consolidated net revenue growth of 6%.
So on a global scale, the company's growing.
Yes, global growth is there. But the number that immediately caught Wall Street's attention, and frankly made some people sweat, is that Las Vegas fourth quarter EBITDA declined 4% year over year.
Ah, yes. The 4% drop.
Right. And management was incredibly quick to frame this 4% decline not as a failure, but as stabilization. They pointed out that it's an improvement from steeper declines earlier in 2025.
Which is a very specific spin.
Exactly. Before we dissect the psychology of that spin, I want to make sure we are grounded in the actual metric here. So from my understanding, EBITDA earnings before interest, taxes, depreciation, and amortization is heavily favored in this specific industry because building a mega resort creates massive paper losses.
Correct. You have billions in depreciation on the accounting statements every year.
But you aren't actually writing a check for that depreciation.
Right. You already wrote the check when you built the building 10 years ago.
So stripping all that out gives you the pure, unfiltered cash profit generated by selling hotel rooms, steaks, and casino chips.
That is the perfect way to look at it. EBITDA is the golden metric here because it isolates operational reality from accounting artifacts and, capital structure.
Got it.
If we want to know how good a management team is at running the day-to-day business of a hospitality and gaming empire, we look at EBITDA. They aren't bogged down by the tax environment or the interest rate on their legacy debt in this specific metric.
So when that pure cash profit from running the Vegas resorts drops 4% in the fourth quarter, the immediate reflex for a retail investor is to view it as a red flag. I mean, a decline is a decline, right?
It is, which is why management calling this a win feels at first glance like pure corporate spin.
Yeah, it sounds like they're just trying to cover up a bad quarter.
But digging into the historical data, the context shifts the perspective completely. We really have to look at the comparables, the comps.
Right. What are we comparing this quarter against?
Exactly. We are judging the end of 2025 against the end of 2024 and 2023. And those were not normal years.
Not at all.
They were historic, record-breaking anomalies fueled by that whole revenge travel phenomenon. Consumers had been locked down, they had accumulated savings, and they just flooded into Las Vegas spending with zero hesitation. The slope of that growth chart was almost vertical.
So you simply cannot sustain a vertical growth slope forever without the macroeconomic laws of gravity taking effect.
Precisely. The 4% decline is framed as a win because the alternative scenario, the one the market genuinely feared, was a catastrophic reversion all the way back to 2019 levels.
And that didn't happen.
No, the demand didn't collapse. It settled at a newly elevated baseline. The floor has been raised significantly higher than it was prior to the pandemic.
So it's like an airplane that climbed at a ridiculously steep angle for 2 years. A 4% drop isn't the plane crashing into the mountain, it's just leveling off at cruising altitude.
I like that analogy. It's a very comfortable cruising altitude, too.
But it forces a broader question. If the consolidated global revenue is up 6%, but the absolute crown jewel of the empire, Las Vegas, is down 4%, the math dictates that another segment of the business is pulling a tremendous amount of weight.
Oh, absolutely. The international and digital segments are doing a lot of heavy lifting.
We will definitely get to those carrying that load shortly, but we need to stay on Vegas for a moment to really understand the mechanics of this newly established cruising altitude.
Fair enough.
Because the actionable takeaway for the listener holding the stock is that the panic over a Vegas crash was overblown. However, when we look under the hood of that 4% decline, it's not a uniform dip across the board.
Not at all. The transcript reveals a tale of two entirely different consumers operating on the exact same street.
Yes, we are seeing a textbook manifestation of a K-shaped consumer trend playing out in real time across the MGM property portfolio.
And for those listening, the downward light of that K represents the budget or value-conscious customer.
Right. And management explicitly called out the Luxor and Excalibur properties during the call.
Yeah, these are the entry-level options on the Las Vegas Strip, catering to the middle-class family or, the budget-conscious traveler.
The data showed that these two properties caused a disproportionate drag on the overall EBITDA decline in Las Vegas.
Yeah.
I actually ran the numbers on that, and it is a jarring statistic.
Oh, yeah. What did you find?
Luxor and Excalibur combined only represent about 6% of the total Vegas EBITDA for MGM.
Wow. Only 6%.
Yeah. For two properties that make up such a tiny fraction of the profit pie to disproportionately drag down the entire city's numbers, the value consumer must be slamming the brakes on discretionary spending.
They absolutely are. The pinch of cumulative inflation is undeniably altering the behavior of that specific demographic.
I mean, we're talking about the family deciding to stay for 2 nights instead of 3, or downgrading from the steakhouse to the food court.
Or maybe skipping the trip entirely because inflation has eaten their travel budget. When a carton of eggs and a gallon of gas cost what they do, flying to Vegas becomes a tough sell.
They are highly sensitive to price elasticity. But then, and this is where it gets crazy, we look at the upward leg of the K, the ultra-wealthy demographic.
Right, and they appear entirely insulated from these macroeconomic pressures.
Totally insulated. The luxury offerings in the MGM portfolio, specifically the Bellagio and area, posted a 7% increase in EBITDA in 2025.
That divergence is staggering.
It really is. The value tier is dragging the average into the negative, while the luxury tier is compounding profit at 7%.
And it's not just about selling nicer suites either. The transcript detailed the sheer scale of the high roller events they are hosting.
Yes, they mentioned a $5 million slot tournament.
And a $10 million baccarat tournament.
What is insane. The logistics of moving that much money around the casino floor for a single weekend event is wild.
But it shows a highly targeted strategy. They are trying to squeeze the absolute maximum yield out of the customer base that simply doesn't care about inflation.
Right. The guy dropping $1 million at baccarat doesn't care what a carton of eggs costs.
Exactly. The strategic pivot toward the premium customer is really a defensive mechanism. The luxury consumer is effectively recession resistant. So
by prioritizing high-end programming like these massive tournaments, management is insulating the top line from the volatility of the middle-class wallet.
But consumer habits only tell half the story of the 4% decline.
Right. There's the physical side.
Yeah, the other half is driven by physical supply disruptions, which are entirely self-inflicted, but, strategically necessary.
You were talking about the MGM Grand Room remodel, which was a fascinating data point to unpack.
It was a massive undertaking.
They took 700 to 1,000 rooms offline per day for the vast majority of 2025 to undergo full renovations.
That's a huge chunk of inventory.
And the CFO stated directly that this disruption cost them an estimated $65 million in EBITDA for the year.
Just vanished profit.
Doing the math on that, losing $65 million in pure cash profit just because rooms are wrapped in caution tape, it feels like performing open-heart surgery while trying to run a marathon.
That's a great way to describe it, because the opportunity cost of a closed room in Las Vegas isn't just the lost nightly rate.
Right.
It's the lost food, the beverage, and the casino drop from the person who would have been sleeping in that bed. The multiplier effect of a closed room is massive. Every empty bed represents a hole in the broader resort ecosystem.
So why do it? Why take that massive hit?
Because in the hospitality arms race, your physical product is your ultimate pricing power. If your rooms feel dated, you immediately lose your ability to command premium rates.
And you lose market share to the newest shiny object on the Strip.
Exactly. Taking a $65 million hit in the short term is a calculated sacrifice. Management highlighted that with this massive renovation complete, the average age of their renovated Vegas rooms is now a highly competitive 6 years.
Wow, 6 years is very fresh for a city that big.
It is. And in this industry, having fresh inventory allows you to confidently push room rates higher and defend your margins for the next half decade.
Now, while they were hemorrhaging opportunity cost on the room remodels, they actually got bailed out a bit by pure mathematical variance.
Ah, yes, the luck factor.
They noted that table game hold was above average in the fourth quarter, adding roughly $20 million to the bottom line.
Which is always an interesting line item to see on an earnings call.
I always find it amusing. Hold is essentially just the casino getting lucky and keeping more of the chips than the mathematical average dictates, right?
That's pretty much it.
Like if a game has a theoretical hold of 20%, but players just hit a terrible streak of variance and the house keeps 24%.
Then that extra 4% drops straight to the bottom line as pure profit with zero associated operational costs.
It's literally free money.
Yeah.
But Wall Street analysts immediately strip that $20 million right back out of their models.
Of course they do. Analysts stripped it out because luck is not a sustainable business strategy. You cannot build a forward-looking financial model on the assumption that the dice will roll your way next quarter.
Right, because standard deviation works in both directions.
Exactly. Next quarter, a few whales could go on a massive winning streak at the baccarat tables, and the hold percentage could plummet below the historical average.
So analysts want to see the underlying fundamental performance.
They want to know the volume of foot traffic, the average daily room rate, the food and beverage margins. Isolating and removing that $20 million windfall provides a much cleaner, more accurate look at the true operational health of the business.
That makes total sense. Now, knowing that the value consumer is drying up at places like Excalibur, I have to wonder about the broader geographical shifts in gaming.
What do you mean?
Well, with the explosion of regional casinos across the United States and sports betting apps living on everyone's phone, the friction to gamble has dropped to zero.
It really has.
You don't need to buy a plane ticket to Vegas to play blackjack anymore. My immediate assumption was that this localized access must be cannibalizing the Vegas trip for that middle-tier consumer.
It is a very logical assumption, and honestly, it was directly addressed during the Q&A portion of the earnings call.
Oh, really? How did management handle it?
They aggressively pushed back on the cannibalization theory. They explicitly stated that digital gaming and regional physical casinos, like their property in Michigan, for example, are acting as massive acquisition funnels to build their central database.
Wait, so they do not view regional gaming as a substitute for Las Vegas?
No, not at all. They view it as a top-of-funnel marketing tool.
Which means my cheap $10 blackjack habit on my phone in Michigan is actually just a loss leader for them to get my data.
Exactly. They get your data, track your behavior, and eventually send you a comped room offer.
Just to get me to book a $400 a night trip to the Bellagio.
Right. It is an omni-channel acquisition strategy designed to lower the overall cost of finding a new customer.
That's brilliant.
Because the friction of acquiring a customer digitally or at a drive to a regional casino is vastly lower than convincing someone to fly across the country. Once they capture you in the loyalty ecosystem, they can systematically incentivize you to make the high-margin pilgrimage to Las Vegas.
So the regional properties and the digital apps essentially feed the flagship destination.
That's the ecosystem they've built.
Okay, so summarizing Vegas. The narrative is actually quite solid. The baseline is stable at a much higher altitude than 2019. The luxury market is compounding. The painful room renovations are complete. And the regional assets are funneling traffic effectively.
The foundation is strong.
But Vegas alone, being down 4%, doesn't explain the 6% total company revenue growth.
No, it doesn't.
To find the engine pulling the rest of the wagon, we have to look across the Pacific at the Macau miracle.
The Macau numbers were just phenomenal.
The numbers coming out of MGM China are staggering, especially when you consider the broader macroeconomic headwinds we constantly hear about regarding the Chinese mainland economy and their property sector.
Yeah, the macro narrative there has been quite negative.
Right. But MGM China saw its fourth quarter net revenue grow by 21%, and its segment-adjusted EBITDA grew by an astronomical 31%.
Posting 31% profit growth in a single quarter for an enterprise of that scale is it's phenomenal.
And they also maintained a record market share of over 16% for the full year.
Which means they are massively over-indexing against their direct competitors in the Macau region. They're capturing more of the available premium mass market consumer while keeping their profit margins incredibly healthy in the mid to high 20s.
Okay, but here's where it gets really interesting. Alongside these massive operational wins, there's a specific corporate maneuver buried in the call that I found fascinating as an investor.
Branding fee.
Yes. MGM Resorts increased the branding fee it charges to MGM China, doubling it from 1.75% to 3.5%.
A very strategic move.
This move secures the brand through the life of the local gaming concession and generates over $50 million in incremental cash flow back to the U.S. parent company.
Right back to headquarters.
Now, to the untrained ear, an auto-renewing branding fee sounds like an accounting gimmick. You know, a corporate shell game of taking money from the left pocket and putting it in the right pocket.
It does sound like that.
But there is a very specific mechanical reason they do this involving minority shareholders, isn't there?
There is. It is a vital piece of international corporate governance and capital extraction. You see, MGM Resorts International, the parent company headquartered in the U.S., does not own 100% of MGM China.
Ah, okay.
MGM China is a publicly traded subsidiary listed on the Hong Kong Stock Exchange.
Which means it has its own distinct base of minority shareholders.
Exactly, meaning the executives in Las Vegas can't just open the cash register in Macau, grab the profits, and use them to buy back stock in America or build a new tower in Vegas.
Because they'd be stealing from the Hong Kong shareholders?
Correct. The standard mechanism for extracting cash from a subsidiary is for the subsidiary's board of directors to declare a dividend. However, when a dividend is declared, it is distributed pro rata. The minority shareholders get their proportional cut of the cash.
Makes sense.
But a branding fee operates differently. It is classified as an operating expense for the subsidiary. By doubling the fee that MGM China must pay to use the MGM intellectual property and the iconic Golden Lion logo, the parent company extracts $50 million of raw pre-tax cash directly to headquarters.
Wow. So it entirely bypasses the dividend process.
Entirely. It ensures the parent company secures guaranteed liquidity, regardless of what the local board in Macau decides to do with their remaining profits.
That is a masterstroke of corporate maneuvering. You're essentially levying a tax on your own wildly successful subsidiary to unilaterally fund your global corporate agenda.
It's highly efficient capital extraction.
And Macau is undeniably firing on all cylinders right now. The CEO mentioned during the call that Chinese New Year bookings have a massive waiting list for top-tier rooms.
Yeah, they are turning away premium business because they simply don't have the capacity.
Yet despite this geyser of cash, the stock market seems to be completely ignoring the asset. Management went out of their way to highlight a massive valuation disconnect.
They certainly did.
They pointed out that MGM China currently trades at a sub-7 times forward EBITDA multiple, compared to an industry average of over 8.5 times.
Right.
For a retail investor listening to this, how should they interpret that multiple disparity?
Well, a forward EBITDA multiple is the market's way of pricing today for expected future profits. You are looking at how many years of cash flow it would take to justify the current enterprise value. If the broader gaming industry average is trading at 8.5 times future earnings, but MGM China is languishing at less than 7 times, the market is effectively putting Macau in the clearance bin.
It's on discount.
Huge discount. Management is signaling to Wall Street that the stock is deeply undervalued relative to its actual cash-generating power. They are highlighting the disconnect between the operational reality, record market share, and 31% EBITDA growth, and the pessimistic multiple assigned by the market.
And that low multiple is likely driven by broad, generalized fears about Chinese regulatory risks or macroeconomics, right?
Yeah.
Rather than the company's specific performance.
Precisely. It's macro fear suppressing a micro outperformer.
So we have the stable, cash-flowing anchor of Las Vegas and the absolute rocket ship of Macau, which smoothly brings us to the segment that has historically been the exact opposite of a cash gusher.
Oh, yes. the digital side.
For years, the digital sports betting and iGaming space has been an absolute bonfire of capital.
Just burning cash.
But according to the data in this earnings call, BetMGM, their North American digital venture, has crossed the Rubicon. For the full year of 2025, BetMGM achieved a nearly $470 million EBITDA turnaround.
It's incredible.
In the fourth quarter alone, they generated $71 million of positive EBITDA, which allowed them to actually make a $135 million distribution back down to their parent companies.
This is arguably the most pivotal inflection point in the entire earnings report. The narrative around digital sports betting has fundamentally shifted from a story of cash burn to a story of cash generation.
A $470 million swing from bleeding cash to making it is staggering. We need to talk about the mechanics of how they actually achieve that.
It wasn't easy.
Because in the early days of the U.S. market legalizing sports betting state by state, it was a brutal war of customer acquisition costs, or CAC. They were handing out $1,000 risk-free bets, blanketing every television broadcast with expensive commercials, just trying to grab market share at any cost.
The promotional spend was astronomical.
It seemed fundamentally unprofitable by design. How did they structurally cut those costs to swing the pendulum nearly $500 million in the other direction?
Well, you have to understand that the hyper-aggressive customer acquisition phase was always designed to be temporary. It was a land grab while the market was nascent.
Get as many users on the app as possible, no matter the cost.
Right. Now, the market has consolidated, the major players have established their databases, so the promotional spending, those $1,000 risk-free bets, has been drastically slashed across the industry.
The free money tap is turned off.
Exactly. But beyond just cutting marketing spend, they have fundamentally improved the unit economics of the product itself by shifting consumer behavior toward higher margin wagers.
What kind of wagers?
Specifically, same-game parlays.
The psychology of the parlay is fascinating.
It really is.
Instead of betting $10 on one team to win, the app incentivizes you to bet $10 on a specific player to score, another player to get a certain number of rebounds, and the total score to be over a certain number.
Right, stringing all those events together.
The payout looks massive to the consumer, but the mathematical hold percentage for the house is astronomically higher than a straight bet.
It's a completely different margin profile.
They engineer a product that the consumer desperately wants to buy, which simultaneously vastly improves the profit margin for the operator.
It is the digital equivalent of moving the consumer from the low-margin blackjack table to the high-margin slot machine. By optimizing their parlay product and integrating their digital users into the physical MGM Rewards program, which, by the way, structurally lowers retention costs compared to digital-only competitors who have to pay pure cash to retain users, they have engineered a highly profitable ecosystem.
And the guidance they provided is incredibly bullish. They expect $300 to $350 million in EBITDA for 2026, aiming for $500 million in 2027.
It's like burning rocket fuel just to break the atmosphere. It costs a fortune up front, but once you're in orbit, you can cruise.
And the growth isn't isolated to North America either. The international digital arm saw 35% net revenue growth, hitting $2.7 billion, driven by established markets like Sweden.
But Sweden wasn't the main international talking point.
You know, the piece of the international digital strategy that dominated the conversation was Brazil.
Right.
They announced a new in-house sportsbook launch in Brazil via a joint venture with Globo. At first glance, a Vegas casino company talking endlessly about South America feels disconnected. Why is Brazil suddenly the most critical frontier for their digital ambitions?
Because the North American market is maturing. The days of untethered exponential growth are behind us here. Brazil represents the next mega market.
How big are we talking?
Huge. It is a massive population with an incredibly passionate sports culture that is just now moving into a regulated sports betting framework. It is a virgin market at scale.
But entering a virgin market usually means repeating the brutal customer acquisition bloodbath we saw in the US. Wouldn't they have to spend billions educating the market and acquiring users?
That's why the Globo partnership is the crucial detail here. Globo isn't just a partner. They are the largest mass media network in Latin America.
Wow.
By establishing a joint venture with the dominant local media conglomerate, MGM effectively bypasses the exorbitant customer acquisition costs that crippled the early days of the U.S. market.
So they don't have to bid blindly for expensive digital ad inventory.
Exactly. They are partnered directly with the network, broadcasting the matches to millions of passionate fans. They are embedding the betting product natively into the existing sports consumption habit of the entire country.
That is a highly capital-efficient strategy to capture market share from day one.
The structural advantage of that partnership is massive.
Okay, so summarizing the financial picture so far, Las Vegas is generating stable cash. Macau is sending $50 million more in branding fees while growing at 30%, and BetMGM is finally kicking $135 million back up to headquarters instead of asking for capital injections.
The company is generating an absolute geyser of free cash flow.
Which brings up the ultimate test of a management team: capital allocation. When you are sitting on this much cash, the way you deploy it determines the long-term compounding value for the shareholder.
Capital allocation is everything at this scale.
And the most eye-popping number in this entire report is the share buybacks. In 2025 alone, they bought back 37.5 million shares for $1.2 billion at an average price of $32.43.
The scale of their share repurchase program is historically significant. Management highlighted that over the past 5 years, they have shrunk their total outstanding share count by almost 50%.
Okay, I have to push back hard on this because retiring half of your outstanding shares in 5 years feels dangerously aggressive.
Yeah, it sounds like a lot.
I get the basic math. Fewer shares mean the earnings per share metric goes up, which makes the stock look more attractive. But isn't this mortgaging the future to artificially pump the stock price today?
That's a common criticism.
I mean, what happens if there's another global travel lockdown or a severe recession that wipes out the convention business? Shouldn't a hospitality company be hoarding that cash in a war chest rather than dumping billions into their own stock?
It is a valid conservative concern. A company heavily reliant on travel and discretionary spending must maintain liquidity. However, you have to look at the buybacks in conjunction with their debt maturity profile and their ongoing capital expenditures.
What do you mean?
They aren't starving the business to buy back stock. They are executing these massive buybacks while simultaneously funding aggressive international expansion.
But is buying the stock at an average of $32 actually a good use of capital? Or is it just a mechanical way to pad the EPS metrics, which conveniently tie to executive compensation bonuses?
That is the cynical view, certainly. But the financial justification comes back to the valuation disconnect we discussed with Macau. Management genuinely believes the sum of their parts, Vegas real estate, Macau cash flow, and a profitable digital arm is worth significantly more than $32 a share.
So they think it's cheap.
Yes. If you believe your asset is fundamentally mispriced by the market, buying back your own equity is the highest return investment you can make. And more importantly, they are proving they can walk and chew gum at the same time.
Right.
They are shrinking the share count while actively funding the largest integrated resort development in the world, MGM Osaka in Japan.
The Japan development is a fascinating piece of the puzzle. Construction is on time and on budget for a 2030 opening, with 20% of the foundation piles already completed. Their funding commitment for Osaka in 2026 alone is $350 to $400 million.
So they really are doing both, returning billions to shareholders and building a multi-billion-dollar mega resort on another continent.
But the financial engineering behind how they are paying for Japan caught my eye. They are largely funding the Osaka project using a low-cost, yen-denominated credit facility.
This is brilliant.
I'll make sure I understand the mechanics of this. If an American company borrows money in US dollars to build a casino in Japan, and then the Japanese yen plummets in value against the dollar over the next decade,
the casino is earning weak yen, but has to pay back the debt in strong dollars.
Exactly. The debt service would explode relative to their revenues, creating massive foreign exchange risk. So by borrowing in yen to build a yen-producing asset, they are naturally hedging that currency risk, correct?
That is precisely the mechanism. It is textbook financial engineering. By matching the currency of the liability to the currency of the cash-generating asset, you completely neutralize the foreign exchange volatility.
It doesn't matter what the exchange rate does.
Right. Whether the yen strengthens or weakens against the dollar over the next 30 years becomes irrelevant to the debt service of that specific property. Furthermore, the interest rate environment in Japan is notoriously low compared to the U.S., allowing them to secure a low single-digit cost of capital for a massive infrastructure project.
That structural detail separates the smart capital allocators from the amateurs. And their discipline isn't just about what they are building. It's also about what they are walking away from.
You're referring to New York.
Yes. The transcript noted they dropped their pursuit of a New York table games license, taking the $500 million they had earmarked for it, and reallocating it right back into buybacks and growth.
which shocked a lot of people.
Because dropping a shiny, high-profile project like a New York casino, which every major operator was fighting over, shows that they are strictly focused on returns on invested capital, not just planting flags on a map for vanity.
The regulatory and political friction in New York, combined with the exorbitant entry costs and taxation rates, significantly compressed the potential return on investment. Walking away from a bad deal is just as important as funding a good one. It demonstrates strict capital discipline.
Speaking of disciplined capital structure, the CFO spent a significant amount of time discussing their real estate leases.
This is a crucial, often overlooked part of their business model.
Most people don't realize that MGM doesn't actually own the physical land under many of their iconic casinos anymore. They spun the real estate into a separate trust and lease it back.
Right, the asset-light model.
The CFO highlighted that their triple net real estate leases have rent escalators capped at 2% for the first 10 years and 3% after that. Let's break down the mechanics of a triple net lease and why a 2% rent cap is such a massive competitive advantage.
Okay, let's look at a standard commercial lease first.
In a standard commercial lease, the landlord pays for the property taxes, insurance, and structural maintenance out of the rent they collect.
Right. But in a triple net lease, the tenant MGM agrees to pay all three of those net costs on top of the base rent.
It transfers the operational risk of the building entirely to the tenant. So why is the CFO bragging about this arrangement?
Because in exchange for taking on the operational risks of taxes and maintenance, the tenant secures a highly predictable capped base rent. In a macroeconomic environment that just experienced severe, prolonged inflationary shocks, a rent cap is an incredible defensive moat. Let's look at the margin implications. MGM's top-line revenue, the price they charge for a hotel room, a steak dinner, or a convention space, can inflate at 5%, 7%, or 10% to absorb the broader macroeconomic inflation.
Because they have pricing power.
Exactly. They have pricing power. However, one of their absolute largest fixed expenses, the rent for the most valuable real estate on the Las Vegas Strip, is legally capped from growing any faster than 2%.
The math on that is beautiful for an investor. If your revenue is inflating at 7%, but your massive rent expense is locked at 2%, that differential flows straight to the bottom line as expanded profit margin.
It is a phenomenal structural hedge against inflation built right into their leases.
So we've dissected the triumphs and the structural advantages of 2025. We know the baseline is secure, but Wall Street is inherently forward-looking.
They always want to know what's next.
They want to know the narrative for tomorrow. Moving into management guidance and macro catalysts, what are the tailwinds that management believes will push this company forward in 2026?
The foundational tailwind they highlighted is the group and convention business. Management stated it is pacing for mid-single-digit revenue growth in 2026, and their strategic goal is to push the convention mix to represent 20% of their total room nights.
And they noted they currently have a record number of future room nights on the books,
which is critical for operational efficiency. Convention guests fill up the hotel on a random Tuesday or Wednesday in October, stabilizing the midweek occupancy dips that otherwise drag down the average daily rate.
And they aren't just relying on standard, plumbing conventions. The call highlighted major events filling the calendar. The return of ConEx, which brings 140,000 attendees to the city.
That's a massive influx of people.
Also, the Super Bowl being hosted in Northern California and upcoming World Cup matches in Los Angeles. Now, Los Angeles is a 4-hour drive or short flight away. How exactly does a soccer match in LA act as a direct catalyst for a casino in Vegas?
It connects directly back to the international luxury consumer we discussed in the K-shaped recovery segment. The World Cup attracts a highly affluent global audience.
Right.
When international high rollers fly from Europe, South America, or the Middle East to Los Angeles for a match, it is almost a guarantee that they will utilize the geographical proximity to book a 48-hour stopover in Las Vegas.
Oh, that makes sense.
MGM is explicitly creating high-end, bespoke programming and leveraging private aviation partnerships to capture that exact demographic as they transit through the West Coast. It is an opportunistic way to siphon global wealth into the Vegas ecosystem.
It's casting a net over the entire region's event calendar.
Exactly.
The CEO also named a few broad macro catalysts that could shift the playing field. He mentioned lower trending interest rates, which obviously reduces debt service costs.
Always helpful.
He mentioned the Las Vegas airport backfilling 50% of the lost capacity from discount airlines, which directly addresses the volume issue at the value tier we discussed earlier.
Getting those cheaper flights back is huge for Excalibur and Luxor.
But the most interesting macro catalyst he cited was potential tax regulations, specifically naming no tax on overtime and tips as a major tailwind. Now, keeping this strictly to the economics of the business, why does the CEO of a multinational conglomerate care about the taxation of tips for frontline workers?
From a purely macroeconomic standpoint, you have to look at the specific demographic makeup of the Las Vegas local economy. It is an economy heavily disproportionately weighted towards service industry workers, bartenders, dealers, waitstaff, bellhops.
Right, the whole city runs on service.
If a policy is enacted that removes the tax burden from their tips and overtime wages, it acts as a massive, hyper-localized consumer stimulus package.
It immediately increases the velocity of money in their immediate vicinity. It puts more discretionary cash into the pockets of the working class people who live in Vegas, who then go out and spend that money in the local economy.
And equally importantly, it puts more cash into the pockets of the working class tourists flying in from places like Ohio or Texas who work in the service industry back home.
For a consumer discretionary business, a sudden injection of cash into the pockets of the middle class is always a potent catalyst.
Exactly. It directly benefits the downward leg of the K-shaped consumer trend that was dragging down the Luxor and Excalibur. Additionally, the CFO noted a strategic timing element regarding their future metrics. The second half of 2026 will have much easier year-over-year comparisons since the middle of 2025 was soft.
The comps again.
So by the time we hit the fourth quarter of 2026, their growth metrics on paper are going to look like they're accelerating rapidly, simply because the comparative hurdle they have to jump over is artificially lower.
But to clear that hurdle efficiently and maximize margins, they have to manage their operational costs, specifically labor.
Right.
The transcript is filled with references to tech efficiencies, fixing labor costs. I'm always skeptical of this phrasing because tech efficiencies is often just corporate speak for replacing humans with AI to slash payroll. Is that the primary driver here, or is there a genuine operational enhancement?
While payroll reduction is undoubtedly a component of the ROI equation for technology investments, the data they provided frames it primarily around removing friction for the customer, which drives downstream revenue.
How so?
Well, they cited that digital check-ins increased by 18% year over year. By migrating that volume to the app, they dropped the average physical wait time at the front desk from 6.5 minutes down to 1.5 minutes.
That is a massive improvement.
They also handled over 1 million customer interactions via their AI concierge chat system, routing basic requests away from human operators.
The psychological impact of that wait time reduction cannot be overstated. If you've ever arrived at a Vegas mega resort at 4 p.m. on a Friday and stared down a lobby line of 1,000 people dragging suitcases,
It's awful.
you know it is a miserable start to a vacation. Dropping that wait time to 90 seconds isn't just about saving labor costs at the desk. It's genuinely removing the absolute worst part of the Vegas experience. If I get to my room faster, my frustration is lower, and mathematically, I am down on the casino floor buying a drink or sitting at a table 30 minutes earlier than I would have been.
It directly alters the velocity of money within the resort. By eliminating bottlenecks, you increase the time the consumer spends in revenue-generating environments rather than revenue-neutral holding patterns.
Waiting in line generates $0.
Exactly. The technology isn't a gimmick. It is a structural enhancement to the user experience that simultaneously protects operating margins.
Which brings us to the ultimate verdict for the listener. We've dissected the K-shaped recovery, the mechanics of table hold, the corporate shell game of branding fees, the massive digital turnaround, the yen-hedged capital allocation, and the macroeconomic catalysts.
We've covered a lot of ground.
If you hold this stock, or if you are considering a position, what is the actionable bottom line?
The results we've unpacked today signal a surprisingly bullish, highly resilient foundation.
The prevailing narrative that Las Vegas was heading for a cliff post-pandemic was simply wrong. The transition is complete, the baseline is stable at a higher altitude, and they're aggressively managing the divergence between value and luxury consumers.
But more importantly, the thesis of what this company actually is has fundamentally evolved.
Wait, MGM is no longer just a physical hotel operator vulnerable to the cyclical swings of Vegas tourism.
It has transitioned into a globally diversified cash machine. It has a digital arm that has finally absorbed its massive customer acquisition costs and crossed into sustained profitability.
That $470 million swing.
Right. It has a dominant, highly lucrative presence in Macau that is legally structured to funnel cash directly back to the parent company. And it is executing a fiercely disciplined approach to shareholder returns.
Retiring half its float in 5 years while simultaneously funding a generational mega resort in Japan.
The discipline to walk away from expensive vanity projects like New York while securing 2% rent caps on their flagship assets shows a management team playing chess while others are playing checkers.
Which leaves me with one final provocative thought for you to ponder as an investor. We spent all this time looking at the present. How BetMGM is finally making money on your phone, how physical casinos in Vegas are upgrading their luxury experiences to capture the whales, and how Macau is printing cash.
But fast forward a few years.
Exactly.
Yeah.
What happens in 2030 when MGM Osaka opens its doors? You are going to have the largest integrated hub in the world, positioned perfectly to connect Asian high rollers directly into MGM's global physical ecosystem and their rapidly expanding international digital betting network.
Staggering vision.
The data suggests we aren't just looking at a successful hotel company. We are looking at the foundation of the first truly borderless, omni-channel entertainment empire. Are we witnessing the creation of an ecosystem where a user can seamlessly move from a digital sports bet in Sao Paulo to a baccarat table in Macau, to a luxury suite in Las Vegas, to a mega resort in Osaka, all within the exact same monetized loop?
If the execution over the next 5 years matches the capital discipline and strategic vision we've seen in this earnings report, that is precisely the trajectory they are on. The traditional boundaries between digital engagement and physical luxury are completely dissolving.
And to think, we started this deep dive talking about the illusion of control on the casino floor. It turns out, the real control isn't in rigging the slot machines or pumping oxygen into the room.
No, it's not.
The real control is building a financial engine so vast, so diversified, and so fundamentally sound that no matter which way the macroeconomic ocean churns, you are positioned to catch the wave. Thank you for joining us on this deep dive into the numbers. Keep asking questions, keep looking past the jargon, and stay curious.